Hey guys, the Fed won't tell you that this is coming, but I want you to pay close attention to the things I'm going to talk about on this quick video because they could be really big and affect us on a large scale. Now, the jobs report just recently came out a few days ago, and it provided some interesting data that the Fed is going to have to react to in its upcoming meeting. And the Fed is going to have to decide if they're going to stay aggressive with continuing to raise interest rates by large amounts, or if they're going to sort of take their foot off the pedal and ease up a little bit on these aggressive rate hikes. Now, first of all, the Department of Labor, every single month, they put out a monthly jobs report. And they put this report out to sort of give a public accounting of either the job market growing or the job market declining, whichever that may be. It's a public report that comes out every single month. And so the most recent jobs report for last month just came out recently, a couple of days ago. Now, what did it show? Here's some interesting things that it showed and what these things really mean for us. Now, let me also say this. If you're looking for a job, this recent jobs report was very, very favorable. It showed pretty much that the job market in America is still very strong. Now, on the other hand, if you're looking for inflation to go down from the standpoint of the Fed, the strong labor market sort of sent a mixed message, okay? On one hand, because the job market is so strong, it sort of sends the Fed the message that they need to keep their foot on the pedal and keep raising interest rates and continue to be aggressive in that area. On the other hand, because it showed a slight uptick in unemployment, it sort of tells the Fed that maybe what they've been doing for a year by raising interest rates is sort of working, or at least starting to work. That lag time is finally kicking in, right? Lag time is just the time between when the Fed institutes a policy like raising interest rates and when that actually starts to take effect in certain markets like the job market. Now, to be clear, the Fed needs unemployment to increase. The Fed needs to see a significant increase in the unemployment rate. Now, right now, unemployment has been at an all-time low over the last several months. So the Federal Reserve doesn't want that. They don't want to see record low unemployment. They need to see significant increases in unemployment so the labor market sort of softens. In other words, the Fed is not going to tell you this, but they need more people to be out of work. They need higher unemployment to show that their increase in rates, interest rates, is actually working in the economy. Now, in this latest jobs report that we just saw a couple of days ago, job growth was actually greater than expected. And again, that is an indication of a strong jobs market, despite what the Fed has been doing in trying to raise interest rates to cool off the labor market. Now, let's talk numbers from this latest jobs report. Non-farm jobs, or jobs that don't include agriculture, don't include nonprofit employees, and don't include active duty service members. Non-farm jobs is what's usually reported and usually the big number that's looked at. Those non-farm jobs last month rose by 311,000. That means there were 311,000 extra jobs created in America. Now that was above the expected 225,000 jobs that they expected to see. But at the same time, it was well below the 504,000 jobs that was reported to be created in the previous month, January. So 504,000 jobs down to 311,000 jobs looks good, sounds good, feels good, but it's still more jobs than they expected to see. And that downturn in the number of jobs that were created just last month in February also kind of shows the Fed that, you know what, things are softening up a little bit because less and less jobs are being created, right? Now that's one thing to think about. The other thing to think about is wages. When wages go up too fast, it's a problem because it means that people are being paid more too fast, right? In other words, guys, it's good to be paid more because the Federal Reserve wants wages to go up. They want wages to go up consistent with a 2% inflation rate. They don't want wages to go up too fast, too soon, more consistent with a 7% inflation rate or an 8% inflation rate. Because when wages go up too fast, too soon, that means people are being paid more too quickly. And what it means is people have more money to spend. More money to spend keeps the demand on goods and services, which keeps the prices high. So they don't want wages to increase too fast, too soon. They want wages to kind of go up slowly at the same rate that's in line with a 2% inflation increase. So in the month of February, wages rose 0.2% month over month, which was actually the slowest month over month wage increase in about a year. Since February of 2022, wages have not gone up that slow. So that's another good indication for the Fed. And it sort of indicates that wage increases are slowing down. And when wage increases slow down, that's another indication to the Fed that maybe what they're doing with these interest rates going up and up and up is working, and potentially inflation is going down. And so the Fed says, we want everybody to make more money. We want everybody's wages to go up. But if everybody's wages go up too soon, too fast, and too high, then the thought process is prices are going to stay high and inflation is going to stay high. So it's sort of a double-edged sword, right? Now, the other critical number that we got to keep in mind that came out with the recent jobs report is the unemployment rate. Now, the unemployment rate on the recent jobs report is up to 3.6%. Now, that's up from the previous month of 3.4%. So now we're seeing that although wages are increasing slower and we've added 311,000 jobs, the unemployment rate is actually going up. Less people are working. Again, when I say going up, I mean going up from the 3.4% that unemployment was at last month. And while that may sound bad that unemployment is up, it's actually, for the Fed at least, sort of a good thing. And again, I know that sounds a little weird, but as unemployment rises, it's sort of good for inflation to go down. So in other words, when the Fed raises rates, it causes a slowdown in the consumption of goods and services. And when less people are buying goods and services, it causes businesses to have to sort of reevaluate and stop raising their prices so much. You don't want to raise prices if people are not buying at those higher prices. So when interest rates go up, people stop consuming and prices can go down. And when prices go down, businesses have to lay people off. And when they lay people off, the unemployment rate goes up. So it all kind of works together. So the Fed is probably jumping for joy that the unemployment rate has actually gone up a little bit. Now, the next big report that's going to be coming out in a few days is the CPI numbers, the CPI inflation numbers, and also the core PCE inflation numbers. Those two numbers are important. Now, the CPI is what we get and we see on ABC and NBC and CBS, but the core PCE is what the Fed is going to use as they do their measurements in terms of inflation. Now, those CPI numbers and core PCE inflation numbers, those numbers, along with the latest jobs report that just came out, is going to give us an indication of whether or not inflation is truly trending up or truly trending down for both month over month and for year over year. Now, year over year is good, but we really want to see those month over month numbers because those are the numbers that show us the latest, trendiest trends, right? So the bottom line for us is this, guys. The Fed later in this upcoming week is going to be having their meetings for the month of March, and they're going to be looking at all the numbers that I've talked about in this video. The jobs report, the unemployment rate, the wage rates increases, and of course, the CPI and core PCE inflation numbers. All those things are going to be at the forefront when they have their meetings over 2 or 3 days. And then we're going to get a report from the Fed chairman, Jerome Powell, to see where the Fed is going. Are they going to do a 25 basis point hike, a 50 basis point hike, a 75 basis point hike? We'll see. All things are pointing right now to the Fed continuing to increase interest rates at an aggressive level in order to continue to squeeze the economy. And keep this in mind, when the Fed increases interest rates, it always has sort of a negative effect on the stock market. Feds raise rates, stock market typically goes down. Great news for investors, but not so great news for older Americans who are seeing their pensions and seeing their lifelong investments go down in value right when they're at the point when they want to be withdrawing money from it, right? It can be a scary time for an older investor. You know, people that are at or above retirement age, and they're relying on this money right now that is dipping and dipping and dipping and going down, right? I mean, they have to, at this point, watch their nest egg go down and down and down, which is not a good thing, right? So you guys need to be ready for that if that's you. And many people are actually saying, guys, that the bottom for the stock market, we're not there yet, but we're getting there shortly. Very, very soon, we're going to see a very bottom of the stock market. So it remains to be seen if that downturn is actually coming. We could be in for something major and something pretty big, depending on what the Fed decides to do at this upcoming meeting. Now, if they really put a squeeze on the market with a, say, a 50 basis points or 75 basis point increase in the federal funds rate, we could ultimately see the 10-year Treasury affected. We could also see mortgage rates affected big time. Right now, mortgage rates are for a 30-year fixed are about 6.5%. We could see that go to 7.5% or 8%. We just don't know. At this point, at the making of this video, mortgage rates have increased over the last 5 weeks steady. 5 straight increases week over week. So those mortgage rates could continue to go up sharply depending on what the Fed decides to do and announces at this upcoming meeting. Now, if you're an investor, keep dollar cost averaging, right? Keep investing because you're buying stocks at a discount. You know, we see lots of undervalued stocks right now. Continue to invest in the stock market, but just be prepared. And as far as unemployment goes, guys, be ready for a continued uptick in unemployment. Yes, we were at 3.4% last month, which was the lowest unemployment in 53 years. Now we're at 3.6%. So it could continue to go up slowly. And that's, again, what the Fed sort of wants to see, because that's going to be good for inflation going down and getting down to that target 2% inflation rate that they want. I'm going to keep you posted on all of this, guys. If you have something that you want me to discuss or talk about, do me a favor, drop that in the comments below. If there's some area of the economy or personal finance or money management or side gigs that you want me to cover, let me know that in the comments below. Do me a favor, guys, smash the like button, subscribe if you're not a subscriber, and make sure you turn your notifications on so that every time that I release a video, you're aware. Hey guys, the best person to take care of the old you is the young you. Do me a favor, take care of yourself, and always take care of other people. Until the next video, peace.